Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 218 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to talk a little bit more about how we go about investing and how we go about picking what to invest in, and we're specifically going to discuss economic moats. And you guys have probably never heard of an economic moat. And if you have, then you likely understand some of the things that I'm going to talk about in today's episode. But this is a concept that was brought up by Warren Buffett. And I think it's worth an episode. It's worth spending some time on because it is so important when it comes to how we go about picking specifically companies that we want to invest in over the long term. And it will help provide value to your investments in a way that very few other attributes of a particular company or a particular stock can. So stick around for that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental material to all the things I'm putting out in the long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan that is specific to you and your family's needs, then I can do that. Just contact me on Twitter, Facebook, Instagram, any of the major social media sites, and I will be sure to get back to you, and we can build a plan for you and your family to help you to reach your long-term financial goals and to reach ultimate financial freedom. And because that is our goal day by day on this show. That's my goal, is to help you to attain long-term financial freedom. And hopefully I can do that for you if you need it done in a specific way via financial coaching sessions. So I want to take us back in time for just a second. And I want us to go back in time to the time of castles, right? And when there were castles, right? If you remember this from when you were a kid and you read books and you saw pictures of castles or cartoons of castles, or even if you've seen actual pictures of old castles drawn or whatever it may be, or reenacted, then what do we know about castles? Castles like to have around them a moat, okay? And this moat, we think of it as filled with alligators or crocodiles, and you don't want to fall into the moat because then you're not going to make it out of the moat. And so what this moat did is it kept the castle safe, right? It kept the castle from being taken over by some other country or some other province or some other kingdom. It protected that castle. And so when we talk about an economic moat, which is what today's episode is about. When we talk about economic moat, we are talking about some attributes of a company that actually protect that particular company from competitors, right? Because in the same way of having a castle and another kingdom coming along and taking over your castle, there are companies that what they do can be taken over by other companies, right? They can be run out of business by other companies given another company's competitive advantages. But if you have competitive advantages of your own that are going to keep other companies out and are going to be hard for other companies to duplicate, right? That is going to create what we are going to call for the rest of today's episode and moving forward, the wide economic moat. And that is what Warren Buffett had in mind when he coined this phrase, right? A wide economic moat is a type of sustainable competitive advantage possessed by a business that makes it difficult for rivals to wear down its market share. The term economic moat was made popular by investor Warren Buffett and is derived from the water-filled moats that surrounded medieval castles. The wider the moat, the more difficult it would be for an invader to reach the castle. And the more crocodiles you had in the moat and the more dangerous animals and the more things that could keep somebody from getting to the castle and taking over the castle, right? The more somebody had to work to get to that castle, the less likely they were to take it over, right? And so that's the whole point. We want to find companies when we are investing that it's going to take a long time to get to the castle, or it's going to be almost impossible to get to the castle. Because we should think about the castle as the main business practices. What is making us money? What is making investors money? What is making the company money? And if you can think of it in that way, and you can think of what's going to keep competitors from getting to that revenue stream or from taking share away from the company's revenues, and you see that it's going to be almost impossible for that to occur, then that company likely has a wide economic moat. Now, a wide economic moat can be caused by several factors that might make it difficult for other businesses to steal market share. These factors may include high barriers to entry, or the business with the moat might own patents on several products that are essential to providing their particular product or service. So I think about, when I'm thinking about moats, I think about it on a more granular level. I think about Shark Tank, right? Shark Tank, small businesses come in, they're looking for investment from the sharks. And the sharks make a decision as to whether or not they want to invest. Well, something that seems to be very valuable to the sharks, if they like a product or something, right? They seem to put a lot of value on patents. And the reason that they put a lot of value on patents and the ability to not be knocked off is because they know, especially for smaller companies, smaller businesses, that if you have a good idea and it goes to market, it's likely to get knocked off by larger companies, and they will steal market share from you in a very fast, swift way, right? But if you have that patent, if you have that protection, right, if you have some type of moat between you and the large company, then you will be able to sustain your revenues and hopefully sustain some business success, at least in the short run, while you have that patent protection, right? So that is just one example of an economic moat. So when I talk about economic moats, what are some companies that we can think of that have wide economic moats? There are many, but I will just talk about a few. First of all, Amazon, right, could definitely fall into this category. The company currently dominates the e-commerce space, representing nearly 50% of online sales in the U.S., according to some projections. It has unparalleled built-in efficiencies, warehouses, supply chain systems that make it a tough competitor for both online and traditional retailers. And this is no surprise. It's no surprise that it's very difficult to duplicate what Amazon has done, and it's very difficult to steal share from them. If anything, they are stealing share from everybody else instead of other companies stealing share from them, right? So they have this wide economic moat because they have all of this infrastructure, right? They have these warehouses popping up everywhere. They have these specific vans. They don't have to rely on FedEx or UPS or United States Postal Service to ship what they have. They do it themselves. They have their own fleet of trucks that goes around and takes packages to where they need to go, right? Amazon is a very dominant company, and they do have a very wide economic moat when it comes to e-commerce and then commerce in general, right? It's not just the online retailers that are getting hurt by Amazon. It is the traditional retailers as well, because they come in a lot of times at a lower cost. And they also come in with better logistics, and they come in with better competitive advantages and advertising than these other companies. Okay, so Amazon is one, and then Walmart is another company often praised for its wide moat. Right, as the largest brick and mortar retailer with a large e-commerce operation as well, it has a big edge in its ability to offer a large number of products at prices that undercut the competition. Right, always low prices, always, right, and you can only get to those low prices by reaching a certain level of scale that Walmart has actually reached. Right, and if they're able to undercut prices of the competitors, then that's going to push market share towards Walmart, and that's going to be part of their large economic moat. Moreover, because it is a discount retailer, it is in the unique position to see strong sales when the economy is doing well as when people have less money in their pockets. And this is a huge thing, right? It's a huge thing for any company to be able to thrive when the rest of the economy is not thriving. And that's something that Walmart tends to do quite well because they maintain lower prices. Now the question becomes, how do we go about identifying companies with large economic moats? Right, or wide economic moats. Obviously, there are companies like Walmart and Amazon that are quite obvious and have moats that aren't likely to be penetrated, right? But what are some things that we can look for, some real tangible things that we can look for that can tell us that a company has a wide moat relative to their competitors? First, earnings performance during bad economic times. I was talking about Walmart and their ability to do this, but you want to take a look at whether the company still seems to be doing well even when the broad economy is struggling, right? This may be an indication that there is something about its business that allows it to remain resilient in the face of tough times. And the two examples I gave, Walmart and Amazon, those are two companies that absolutely are able to do this. You just look back to last year during the pandemic, and throughout the entire pandemic, these companies were able to thrive because they have services and they have products and they have the convenience that people want to rely on when things are going bad, and they have pricing that is going to be advantageous to consumers in a lot of cases, right? So their earnings performance did not suffer just because the economy suffered, okay? So that's the first thing that we would want to look at. And there's a ton of other companies that fall into this area as well. And not just a specific set of bad times, right? Even if bad times fall, particularly hard on a particular sector, which does happen, right? That doesn't mean that a company within that sector can't be still profitable and still doing relatively well and still have a good wide economic moat. Now, another thing that may show us that a company has a good wide economic moat is the cash on hand that they have. Many companies make a choice to keep a lot of cash rather than reinvest it or pay dividends. And a lot of investors actually don't like this. A lot of investors don't like the fact that companies hold a lot of cash. One such company that does hold a lot of cash is Berkshire Hathaway. And they have been scolded time and time again by investors about the fact that they do hold a lot of cash, and the investors want them to reinvest that cash, or they want them to return it to shareholders in some way. Now, they do buy back a lot of stock, so they are returning some of it to shareholders, but they still have a very, very large, a record large cash pile, okay? And investors don't necessarily like that. Now, some may argue that the company should spend its cash or give it back to investors, but having lots of cash on hand does give a company a strong cushion if revenues don't meet expectations, right? It is conservative financing. Right? If you have a ton of cash on hand, then you are more conservatively financed because you can get your hands really quick on money. You have the ability to meet your current liabilities, your current debt obligations, or whatever it may be, without having to worry too much because you have a large cash pile. Now, this doesn't necessarily mean that another company can't do what you do, but having a large cash pile can provide some cushion for you in other areas as well, specifically litigation. Right? If you can, pay lawyers really, really well and have a lot of cash there in case there is some litigation risk to whatever you do or your company does, then that can help to create a wider economic moat. Or if you can use some of that cash for R&D and being able to develop new products and do new things that no one has done before, then that can help to widen your economic moat as well. But the fact of the matter is that a lot of companies don't have a lot of cash on hand. And so having a lot of cash on hand is a distinct advantage that is going to allow you to invest in a way that your competitors absolutely cannot. Okay, so cash on hand, that's another thing. Then financial performance compared to competitors is another way that we can identify a wide economic moat. Okay, so first identify the company's key competitors, then compare their revenues and profits. If there's a big difference between your company's earnings and those it competes against, right, you can say that it has a wide moat. And furthermore, when it comes to talking about the financial performance compared to competitors, a lot of times companies that have wide economic moats do not have a lot of direct competitors. And the reason that they don't is because they have such a competitive advantage in the space that they're in that nobody is trying to do exactly what they are trying to do. And even if somebody is trying to do exactly what they are trying to do, nobody's doing it as successfully as they are, right? When I think of this, I think of Apple. Right? Nobody's trying to do what Apple does. Apple competes with some other companies that create computers and devices and phones and things of the like, but none of those companies are anywhere near the market share that Apple has. Nobody has taken over the consumer in the way that Apple has. Okay, but Apple just taking that market share doesn't necessarily mean that they would have blowout financial performance relative to their competitors. So you do have to check that. But they do typically have blowout financial performance relative to their competitors. But you want to look at this because if one company is growing their revenues a lot and growing their earnings a lot and being really efficient with the capital that they have and creating a good ROI, a good return on investment and return on assets, and other companies in the same sector, in the same industry are floundering, right? There may be a reason for that. So a company that has a wide economic moat is likely to outperform financially relative to its competitors. And so that's something that you may keep your eye on when it comes to finding companies that meet this criterion. Then another way that we can identify a company that has a wide economic moat is if they have dominance of a single product. And this brings me back to Apple, right? Apple has dominance of a single product, and that product is the smartphone, right? They started it, and sometimes companies that start a particular idea don't follow through, and they don't become the best. But Apple was the first, and they have been the best. Now, people may say, oh, well, this phone has better specs, or this phone has more capabilities. You can do this and that, and it's cheaper and all this type of stuff, right? But nobody has gotten to the market share of Apple, and nobody has really splintered the consumer loyalty that Apple has, right? People who buy Apple products tend to stick with Apple products because they are user-friendly, they are addictive, right? Many may argue that in the way of cigarettes or tobacco companies back in the 50s, 60s, 70s, right? Apple has a product that does have a level of addiction to it, right? And people like to hold it in their hands. They like to look at it. They like to get notifications. They like to have everything in one place. And Apple does that better than anybody else. And they dominate that single product, right? And in dominating that single product, that just makes their economic moat wider and wider, because if nobody can do a product the way that you can keep on just stepping that product up incrementally, the way they have done the iPhone. Because people talk all the time about, like, why doesn't Apple do more with their upgrades of the iPhone, right? The next generation of the iPhone. Why is it not better each time? Well, the reason it's not better is because it does not have to be, right? Why would you take 10 steps forward as a company as far as innovation goes just because you can? You absolutely wouldn't. That's not economically smart. It's smart to incrementally add things, right? And keep the customer appeased as long as you have that market share that you always have. I would almost guarantee you that if Apple had any really, really strong competitors that were taking market share away from them in the smartphone space, that they would innovate like crazy. And they would have some things up their sleeves that we may not be ready for yet, right? But this is a company that dominates a single product. And if a company dominates a single product, they are likely to have an economic moat that is quite wide. Now, in a similar way, if you have that dominance of a single product, you likely have a lot of name recognition, right? Google is one that I use often, and I've talked about already this week as far as name recognition goes, right? It is a verb to Google something, right? It's not just the name of a company. It is a verb. It is something that you actually do. So they dominate the search engine space, right? There is no other search engine that gets anywhere near the traffic that Google does. And given that that is the case, they have a very wide economic moat, and they have been able to dominate the industry that they are in. And so moving to the next way that we can recognize a company that does have a wide economic moat, we can recognize them by their intangible assets. Their intangible assets. Now, what does that mean? Right? Assets that are not tangible. So this would be things like fanatically loyal customers, right? Profit margins or cash returns on invested capital that consistently exceed industry average or those of their competitors. Successful companies with high-priced quality products or services for decades supported by their brand strength. And then companies that have softwares and they have patents, right? And they have things that are not tangible. You can't grab them and hold on to them, right? But you can identify that they are there, and they're keeping other companies away. They're keeping a competitive advantage in whatever field that they are in. Okay, you think about a lot of these tech companies, what they have going for them is their intangible assets, right? They have these intangible assets that other companies just can't get their hands on. And even if they try to get their hands on, it's not going to be effective over time because they may not have the same human capital in order to innovate in the way that some of these companies have over time. So intangible assets is a very, very huge thing. Intangible assets, kind of goes along with the idea of intellectual property. And intellectual property is very, very important because if you have ideas, if you have blueprints or softwares or whatever, or some computer code that is going to be revolutionary in a particular space, then it is important for you to keep that under wraps, and that can provide you a competitive advantage and widen your economic moat out. Okay. So intangible assets, then customer switching costs, okay? Products and services that are not easily abandoned for a substitute or a competitor's product. And again, this brings me back to Apple, right? I'm making the case for why Apple has such a wide economic moat. Well, think about the frictions, right? Maybe not the direct cost, but the frictions of switching from an Apple iPhone to another phone. Think about how when you go and buy a new Apple iPhone, all you have to do is sit it beside your old iPhone and it can sync everything directly to that new phone, right? You don't have to plug it into anything anymore, right? You don't have to sync it to a computer like you used to have to do, right? Everything is cloud-based and you can do things in a way that it's very simple to move things from one device to another. It's very simple to upgrade that device to something new. It's very simple because you know how to use that device. You've gotten used to using that type of device over time. But if you were to switch, right, not only may it cost you some money, right? It might cost you some money to switch, right? But it would also cost you convenience, right? It would cost you the convenience of maybe you'd have to go back in and enter all of your contacts manually. And if you go and scroll through your phone contacts, that's going to be a big pain, right? Maybe you're going to have to go through and figure out how to download apps because you don't have the Apple App Store anymore. And you're like, I don't know how to do this, right? So there's going to be quite the learning curve if you want to switch to a device that is not an Apple device. I can tell you this, even switching to an Apple device. So I used to use only PCs, right? I never used Macs, right? Mac computers. But then I started using a Mac and I fell in love with it. But there was a learning curve to using a Mac, right? But then once I used it, now I don't want to go back to using something that is not a Mac because I know that there's going to be some friction there. Now, not as much because I still use PCs just about every single day, but using a Mac personally is very, very comfortable for me now, and it's something that there's going to be an indirect switching cost there that is going to get in the way of me wanting to change. It's going to get in the way of me wanting to switch products, and so that is why Apple has such a strong economic moat, specifically when it comes to the smartphone space. So customer switching costs, if they are high, that can show you a wider economic moat. Now, another thing is a cost advantage. So meaningful economies of scale and over a decade of healthy operating and profitability ratios can really show you that a company has a big cost advantage. And companies that have these types of cost advantages are companies like Walmart, companies like McDonald's, right? McDonald's sells fast food, all in all, cheaper than most other fast food restaurants. And then Johnson & Johnson is one who sells products very cheap and has a cost advantage relative to their competitors because of their scale, because of their size. And you notice a lot of these companies that I'm talking about are larger companies. And the reason that this is because when you reach a certain level of scale, it's difficult to compete with a company at that particular scale. And along the way, it's been difficult to compete with these companies because they have the quote unquote secret sauce, right? They have this particular thing or number of things that is providing an advantage for them and is creating a wide economic moat to where other companies can't come along and steal share from them. All right, so cost advantage. Then also the networks effect, right? Networks that become more useful as people join is something that is going to have a very wide economic moat generally, right? We think back to the days of the early internet, and something that really popped, right, really became huge because of this network effect was eBay, right? eBay was the first place where you could go online and you could sell things direct to other people just out of your own home. You could take a picture of it and you could set the price, or there could be an auction or whatever, and you could sell things to other people. And it got more valuable and more useful as more people joined because it actually created a new market. It created a more efficient market as more people joined in, right? And it was hard to compete with that type of market because of the scale, because of the number of users that came along. The same thing kind of happens with a company like Facebook, right? As they have more active users, as they have more people on these networks, right, it becomes more useful for everybody, and it becomes more interesting to get on and actually be a part of, right? So this network effect can provide companies with a wider economic moat and can pique our interest when it comes to investing. And then the last thing that I want to talk about, and I've talked about it a bit already, but the last thing that I want to talk about when it comes to identifying a company with a wide economic moat is efficient scale, right? Monopolies that exist for the purpose of efficiency, consistency, positive free cash flow, and dividend payouts, right? Those are what we're looking for. All right, we're looking for companies that are efficient, right? There's very few people doing the same thing, right? They have positive free cash flow and potential dividend payouts that can be positive as well, or the active repurchasing of shares. So all we're really looking for is providing capital to shareholders, to investors, okay? And if they have this efficient scale where they can do all these types of things, then that can be a sign of a wide economic moat and can be a sign that you can invest in this company and be quite assured that your money is safe and that you will get some adequate return over time. So something that I think is very important, right? We've talked about all these different identifiers of companies with wide economic moats. But what's important is when you're sitting down to do your analysis, right? You don't just have to invest in companies that are the absolute best. I talked a lot about Apple. I talked about Walmart. I talked about Amazon, right? These are some of the best companies in the world at what they do, right? If not the best company in the world at what they all do respectively. Okay, so I don't expect you to just invest in those type of companies. But what I do expect is that when you are trying to pick individual companies to invest in, that you're looking for the competitive advantage. You're looking for the thing that they do better than anybody else. And it doesn't have to be so glaringly obvious as Apple and the smartphone. It doesn't have to be so glaringly obvious as the low prices of Walmart or the logistics of Amazon. It does not have to be that. But what it does have to be is something that over time, other companies are not easily going to poke holes in. And they're not easily going to take market share away. And not only are they not going to take market share away, that particular company is going to continue to grow and build market share over time. Because what we want when we're looking for a stock, right? We want growth in future cash flows. Right? We want growing future cash flows because the price of a stock today, the price of any financial asset today is the present value of all future cash flows. Well, the future cash flows are the cash flows that the business puts off, right? Well, if those cash flows are not increasing over time, then neither is the price of the stock. Okay, it's not going to be very beneficial for investors to own a stock that is not going to be providing as a business positive free cash flow over time. Okay, so we want to look for growing free cash flows. Okay, and if these free cash flows are not growing, then we're not really interested in that business. Okay, we want to find companies that are going to grow. We want to find companies that are going to increase their market share, increase in what they do over time. And if you find a company that, yeah, they may have a wide economic moat, but they're not growing their share and there's no growth opportunities, and that might not be a good investment for you, because stability is one thing. Stability and having a company that's very stable, like let's say an AT&T, right? They do some things better than anyone in the world, but they are very stable. There's nothing high growth about them. There's only so much more share they can take up. Same thing with Coca-Cola, right? And that's why these companies have gone to really passing their net income back on to shareholders in the way of dividends in a very real way, because they know that their growth opportunities are very, very low at this point in their business cycle. But they still dominate, right? They still have brand recognition. They still have customer loyalty. They still have things that they do better than others that have created a wide economic moat and have created a lot of value for shareholders over the long term. Right? So we need to be looking for these types of things, and you can find them in smaller companies, but they are glaringly obvious in the large companies because these companies have gotten to be that way because of the economic moats that they have created. So this is just another thing that hopefully you can add to your repertoire in understanding how to go about analyzing a company and what you need to look for specifically when you're trying to make individual stock investment decisions. So thanks for watching this episode. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan that's specific to you and your family's needs and keep you accountable to that plan over the long term, then send me a message on Twitter, Instagram, Facebook, whatever site is most useful for you, right? I check them all. And we can get together and we can start having financial coaching sessions that will allow you to reach your long-term financial goals and will ultimately lead you into financial freedom in a very real way. So tune in tomorrow as I talk about diversification and whether or not that is a bad concept when it comes to your investments. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.